Hi, this is Stewart Scothorn from the Long-Term Care Link. Today we have a math problem. Not really a math problem like you're thinking, but I want to ask you a question because we're going to kind of walk through scenarios. And I want you to think of it as if it is you that's on the other side of this. So if you know, and the first thing is to be cognizant of the fact that long-term care insurance or coverage is essential for everyone. And the answer about saying I will self-fund, in our experience, has fallen extremely short. We've not seen anybody come out of that the way that they planned on it. Why? Because the cost was too much, the timing was poor, and it cut directly into how they were going to live the rest of their lives. It's impossible to plan on something that's really meant to be insurance, right? That's why you buy it in the first place. Well, let's talk about the math problem now. So the math problem today is, let's just assume that you do qualify and you are able, even though it is difficult, if you watch some of my other videos, to get long-term care insurance. Let's assume you do, but let's just say it's $500 a month. And let's just say that, so that's $6,000 a year. Let's just say that you spent 20 years paying that in and it never went up. Well, we know that's $120,000. That's not reality, guys. A lot of these long-term care policies are going to go up. They're going to go up every year. Some of the ones that I see are going up almost 100% a year. And unfortunately, the clients are having to drop them after they'd paid into them, in some cases 20 years. So that money is gone. But let's just use the example that I did in the math problem. You have $120,000 that you paid over those 20 years into this $500 a month long-term care policy. And at the end of 20 years, right now, you're saying, well, I don't know if I need it, I don't need it, but that's all that you have. If you want it, you got to keep paying and you go forward that way. Well, let's now look at today, and let's just say that you put $100,000 into, let's use a fixed index annuity with a long-term care rider. What could that look like? Well, immediately day one, you have $300,000. You can get up to $300,000 in benefits for long-term care coverage. So automatically, in day one, the math problem is really easy to figure out. There's really no difference between the 120 that you paid with nothing and the 100 that's still your money that you will continue to earn a return on. But if you needed long-term care, you'd have up to $300,000 in benefits. That's easy to look at that math problem and say, that makes all the sense in the world. Now, keep in mind that benefit will continue to go up as that fixed index annuity grows. So over the course of the time, you'll see that benefit continue to increase, which is why we really believe from a hybrid product, that one is certainly one of our favorites. We can look at life insurance as a hybrid option as well. Again, I'm just giving you the math examples of what traditional long-term care insurance could cost you and really where we're at right now with a hybrid policy. In my mind, it's a really simple thing. You use your money to work for you. You are able to get a benefit to cover a cost that you have a strong probability in needing. And again, that's what insurance is for, but it's something that we need to plan about. So I would encourage each and every person that has a chance to really watch this, go ahead and click the button below. Make an appointment with one of our agents to kind of walk through some scenarios and protect you from what I would tell you right now is probably in 2025 and going forward, the biggest wealth destroyer will be long-term care coverage that people don't have. Thanks again. This is Stewart Scothorn from the Long-Term Care Link.